So how do you accurately estimate your income for covered California? In this video, I'm going to be covering why estimating your income matters, covered California, how to think you have a crystal ball, what determines your tax credits, understanding the income that you actually report, what to include as income, what not to include, estimating your household income, and what to do if your income changes throughout the year. Okay, very important information. If you get the income wrong, then you take on the chance of having to repay a lot of tax credits. I've seen it before, and it's not pretty. I'm Sebastian Vitug. I talk to people about their health insurance every day. I've seen what works, and I've also seen what can cost people big time. So, getting into this, why estimating your income correctly matters. This is so crucial because Covered California bases your health insurance tax credits on your estimated annual income. And why does that matter? Well, your tax return will later show what you've actually earned and if your estimate was off. For example, let's just say in 2026, you project a household income of $50,000, but you end up making $70,000. What's going to happen is that you're going to have to pay back some of the tax credits that you shouldn't have gotten in the first place, right? You took too much of a tax credit. The IRS is going to ask for some of those credits back, right? The opposite is also true. If you projected 50,000 but you've only made 40,000, then the IRS will repay you a tax credit, the tax credits that you should have received throughout the year of 2026. And this will be reflected on your 1095-A tax form, which you receive from Covered California, which this 1095-A is going to show how much of a tax credit that you took for the full year. You pretty much file that with your taxes. You're going to reconcile it with a different tax form. And the IRS basically will be able to see how much of a tax credit you received and how much you should have received. And then you either have to pay back the difference if you weren't eligible for those extra tax credits, or they'll actually pay you back a tax credit if you were eligible for more tax credits. All right, so Covered California thinks you have a crystal ball. They want you to predict the future, right? Things happen throughout the year. They expect you to estimate what your income will be for the entire year. Last year's income doesn't matter, right? We're not looking at last year's income. We can use it as a reference to estimate the next year's income, but they're not asking for the last year's income, right? Again, you can use it as a guide to project this year's income, but again, be careful because sometimes that doesn't hold true, right? If you are a 1099 contractor, your income can fluctuate, right? Like maybe last year you landed a big contract that increased your income pretty dramatically. Maybe next year you're not going to land that big contract. Again, so income can fluctuate. Just be careful when estimating your income. Maybe you're working a job, you changed jobs or you got a raise, you started or you stopped a business, or you had a period of unemployment. These are some factors that can make your income fluctuate throughout the year. So just try to do your best to give it your best guess. Cover California, again, they think you have a crystal ball and they just want you to give it your best guess. And by the way, I don't want to make it seem like I'm hating on Covered California. It's really the federal marketplace as a whole. They want you to project your income for the following year. So it's not just Covered California. Now, moving on, what determines your tax credits? It's pretty straightforward. It's based on these factors right here, primarily your age, zip code, household size, and your household income. This is going to be your household tax size. So whichever dependents or whichever spouse you're filing with, those people will count towards your household size. All right, understanding the income you report. So Covered California uses your modified adjusted gross income, or your MAGI, which is very similar to your adjusted gross income, right? For most people, it's just going to be their adjusted gross income. For example, W-2 employees' income can be pretty straightforward. It's based on your wages, salaries, and tips. But again, update your estimate if your job or hours change throughout the year. For self-employed individuals, you're going to want to report net income after deductions. Right? They don't care about your gross revenue. After deductions, what you take home, before taxes, after deductions, that's the income that they're looking at. And again, income can fluctuate. Like you get a large contract that you didn't anticipate, or you incur unexpected business expenses. Okay. So what to include as income? Again, it's pretty straightforward, just your wages, your tips. Just take a screenshot of this so when you do estimate your income, you can just look at this and reference this to see if any of these other income factors actually apply to you. Okay. And again, lottery and gambling income, this right here is, it's not funny, but it's um, kind of a silly scenario that happened. I had somebody that I spoke to a few months ago who he was projecting a $30,000 income. He was single, projecting $30,000 income. And he is a regular casino goer. He goes to the casino. And he won a jackpot. He won big. And his income for that year was $100,000. So he projected $30,000 for 2024, but he actually made $100,000 because he won jackpot. So he had to pay back over $12,000 in tax credits. If he had known that he would have won that jackpot, he may have not, taken as much of a tax credit because he would have knew that he would have had to pay all those back. And that kind of goes back to my point of, they think you have a crystal ball. They think we can predict the future, but that's not always the case, right? You never know. Things happen throughout the year, right? You could get a new job. Maybe you're getting paid less. Maybe you lose your job. And things just happen throughout the year that you're not even anticipating. But that's just how the system works. That's just how it's designed. So we kind of just have to play within the rules. What not to include as income, or just take a screenshot of this. Child support, I guess, could be pretty common, but everything else is pretty uncommon. But these are just things to not include as income. Estimating your household income. So yeah, again, look at your previous tax return. We've kind of already gone through this. Add or subtract any changes that you expect for this next year. Okay, everybody in household income, right? Your spouse, you're going to want to include their income. So what to do if your income changes? Update your Covered California application as soon as possible, preferably within 30 days, because you want to have your premium tax credit adjusted according to your new income. So you're not taking too much of a tax credit anymore, or maybe you will get even more tax credits for the rest of the year. And yes, you may be asked to provide income proof like pay stubs, tax returns, W-2s, or 1099s to verify your income. So get those documents in order if you're looking to change your income. And if you need help with Covered California, I'd be very happy to help you. Just schedule a call with me. It's the first link in the description. Book your free call. I'd be happy to help you estimate your income for the year, help you look for plans, change your plan. And yeah, just book a free call with me. First link in the description.